Yo, what's good, boys? So in today's video, I will be explaining my 6-figure trading playbook that you can literally download for free. You don't have to send me anything. You don't have to buy my course like all these fake gurus or anything. You don't have to do anything. It's a simple download. And in this video, I will be explaining the whole playbook, the whole strategy step by step. But there's two setups in this strategies, and there's 4 entry types to those setups. So setup 1 is breakout plus liquidity grab, setup 2 is fake out plus liquidity grab, and as I said, there's 4 entry types to those setups. So without further ado, let's get into the charts and let me explain what actually goes on and what each setups means. All right, so let's go over it fast. So what is a breakout? So the setup 1 is a breakout plus liquidity grab, and we need to figure out what a breakout is, right? So a breakout is just whenever price closes, so breaks out and closes above or below a significant level. So in this case, this is the breakout candle. Why? Well, very clear. There's a level up here, resistance level, you can call it whatever you want, resistance level here, support level down here. This candle right here breaks out of this level and closes above this level. So the body right here closes above this resistance level, and vice versa. If we were to go to the downside and have a breakout candle to the downside, it would look like this, right? So very simple. That is what a breakout is. Let's figure out what a liquidity grab is. So now, what is a liquidity grab? So a liquidity grab is whenever price wicks out a liquidity pool, equal highs or equal lows, right? It's basically the same thing. So there's equal highs up here. Why? Well, because these highs right here never ever pushed above these highs right here. So equal highs, and vice versa, equal lows down here, because these lows never reach these lows, right? So there is there's resting liquidity down here and resting liquidity up here, right? So a liquidity grab is whenever price suddenly wicks out and collects all this liquidity, liquidating these lows right here, and then starts flipping in the other direction, right? So that's to the downside, and if price were to do the same thing to the upside, look like something like this, right? So that's a liquidity grab. So now that we know what a breakout and a liquidity grab is, how do we take advantage of it? So if we draw a bullish breakout candle right here, right? So this breaks out, closes above this level. The next candle, however, first off starts by pushing down, grabbing these lows right here, and then starts flipping bullish, right? Can you see it? So it would end up looking like this. So first off started by pushing down, then started flipping bullish, just like that, right? So this now becomes a breakout candle right here, because this body closed above this level, plus the next candle grabbed liquidity. So a breakout plus liquidity. That's the setup, right? So how do we take advantage of it now with 4 entry types? So the first entry type is a candle flip. So whenever price goes from bearish to starts flipping bullish, right? So price, obviously it had to grab liquidity first. So price starts by going bearish, grabs liquidity, liquidating these lows, then starts flipping bullish. So your entry would be right here, the stops below, targeting highs, new higher highs, right? That's the first entry. The second entry is the break of the previous higher low. So the break of the previous wick. So right here, right? That's the entry, because it breaks this wick, this previous wick, stops below and targeting new higher highs, right? The third one is the break of the current candle's wick. So let's say that price first of all started by making a mini top wick and then started flipping bearish, liquidating these lows, then started flipping bullish again. So your entry would be the break of the current higher low. So in this case, the break of the current wick. So it would be somewhere like that. The stops below, targeting new higher highs, right? The fourth entry is an impulse entry. And what is an impulse entry? Well, I can draw it out for you guys. So let's remove this candle, and an impulse entry is a bit different. It's whatever price breaks out. Let me draw it. So breakout candle, and then the next candle closes above the level, but it respects the level. So it closes bearish, but it respects this level. Does that make sense? Right? Because this candle is a breakout, the next candle, weak bearish candle, but it respects this level because the body closed above the level, right? And then the next, what is it called? The next entry is an impulse entry, obviously, and it is whenever price first of all starts by pushing down, grabbing liquidity below these lows right here, and then starts flipping bullish. So it would form something like this. Starts off by going down and then goes up, right? So a breakout candle, a candle, bearish candle that respects this level, so it's still a breakout, right? plus a liquidity grab, it's just a different entry. So it's called an impulse entry because you take impulsive entries when it breaks this candle's high right here. So your entries would be right here, right? Stops below, targeting higher highs, whatever, like up there somewhere. That's the 4 entry types for setup 1 breakout plus liquidity grab. So candle flip, break previous higher low, aka breaks the previous wick, break current higher low, aka break current wick, right? And then this impulse entry whenever price breaks out right here. The next candle closes bearish but closes weak bearish, respecting this level. Then the next candle pushes down, liquidates these lows right here, and then start flipping bullish. So you take impulsive entries when it breaks these highs right here, right? That's the 4 entry types to setup 1 breakout plus liquidity grab. So now setup 2, which is the fake out plus liquidity grab. So first of all, like before, we need to figure out what is a fake out. So a fake out is essentially just whenever price closes below a certain level or above, then closes back into the range. So it would look something like this. Let's start off with the bearish version of it. Actually, it's a bullish version because it's a fake out. So a fake out to the downside to then go up, right? So this candle breaks out, so it looks like a breakout, right? It looks like a very, very clear breakout. But the next candle breaks and closes back into the range like this, right? And this wick right here never closed below or broke below the previous wick, right? Does that make sense? So this wick never closes or breaks below this wick. So there's actually equal lows down here. Now, this is a breakout candle, but this is a fake out candle. So it's a fake out, right? Because this candle right here closes below this support, but the next candle quickly comes up and closes back into the range, back into this range, right? Back into this consolidation area, right? So this is a fake out for price to continue to go up. So it would probably look something like this, right? Very, very simple. So that's to the downside for price to go up. Let's draw it to the upside for price to go down. Yep. Let's do some quick drawings. So a breakout candle right here. Next candle does what? It closes back into the range, right? Because it's a fake out, right? So it closes back into the range and it never breaks this highs up here. Never breaks this. Because if it broke, there would be a very, very high probability that price would just fly up. Because it breaks this high right here. But in this case, it's a breakout candle. And then the next candle is a fake out candle. So now that we know what a fake out is, how do we take advantage of the liquidity grab and with the 4 entries? So a fake out right here, you can see breakout plus fake out. So this is a fake out right here because this candle closes back into the range, right? So now we simply just wait for a liquidity grab. And what do I mean by that? So we start off the next candle by pushing up, breaking these highs right here, but ends up flipping bearish. Okay, so it pushes up first, grabs liquidity, liquidates these equal highs up here, then starts by flipping bearish. So it would look something like this, right? Very, very clear fake out plus liquidity grab. So that's a fake out plus liquidity grab to the downside by going up first, faking out all these early buyers right here, grabbing all this liquidity, then closes back into the range with this candle, then comes up, grabs liquidity. So a fake out. So let me draw it out for clarity. So a fake out plus liquidity grab and then the continuation down, right? So what is a fake out or what is a liquidity grab to the downside before price goes up, right? Let's draw that first. So let's delete these candles and let's draw a bearish breakout candle to the downside. Everyone thinks, or all the retail traders think that this is a breakout. They take sells right here. And what does price end up doing? Well, it closes back into the range like this, right? Because it never breaks these lows down here. This candle right here never breaks these lows, because if it would have broken these lows, there's a very, very high chance the price will continue to fall down. But instead, it ends up closing back into the range, back into this area, back into this consolidation area, right? And now we simply just wait for the liquidity grab. So price starts off on the new candle by pushing down, liquidating these lows, and then starts flipping bullish, right? So it would end up forming something like this. First push down, then flip bullish, right? So it's a fake out plus a liquidity grab. The fake out is here, the liquidity grab is here. Now, how do we take advantage of this fake out plus liquidity grab with the 4 entries we have? So the first entry is whenever the candle flips. So whenever it goes from bearish to bullish. So the entry would be right here, right? With the stops below, targeting new higher highs, right? That's the first entry. The second entry would be the break of the previous higher low. So in this case, the break of the previous wick right here. So the entry would be right here when it breaks these wicks, this previous wick right here, targeting all-time highs, targeting new higher highs. The third entry would be break current candle. So the break of the current candle's wick. So just like before, it would be somewhere like that. The stops below, targeting higher highs, right? That's the third entry. The fourth entry is an impulse entry, just like before. So we have to draw it out. So the next candle after a fake out, the next candle closes weak bearish, but respecting the level. So let me draw it out. So the next candle pushes down, but closes like this, like weak bearish right here, right? But still respecting this level, respecting this range. So it's still in a range, right? Then the next candle starts off by pushing down and then starts flipping bullish, right? So an impulse entry would be right here. So starts off by going down and then starts flipping bullish, right? So it's a fake out right here, fake out the bearish candle that respects this level right here, then the liquidity grab. So fake out, liquidity grab, then you take impulsive entries right here when it breaks the previous high right here, and then you're targeting new higher highs, right? Stops below, targeting new higher highs. That's the 4 entry types to a fake out plus liquidity grab. And just for clarification, let's do it the other way around. So we start off by creating a fake out, so it's a breakout to the upside, but then the next candle never breaks the high right here, and it starts by closing, or it closes back into the range like this, right? Never breaking these highs, but ends up closing back into the range right here. So the next candle would look something like this. It would start off by pushing up right here, breaking these highs, and then starts flipping bearish. So let's make this black. And starts by pushing up, then flips bearish, right? Oh, that's way too much. Right there. So a fake out candle plus a liquidity grab. And let's do the 4 entry types to this fake out plus liquidity grab. So the first entry is a candle flip. Whenever price goes from bullish to bearish with the stops above, targeting new lower lows. Second one is the break of the previous candle right here. So the break of the previous wick right here, targeting, or I mean stops down there, targeting lower lows. Third entry is the break of the current higher low. So the break of the current wick, so it would be somewhere like this. The stops above, targeting new lower lows. The fourth entry, the last entry to this fake out plus liquidity grab, is the impulse entry, right? So it would look something like this. We would get a bullish candle that closes weak bullish, but with a top wick that still respects this level. So this candle still respects this level right here. So it closes below, this candle closes below, it's a fake out. This next bullish candle closes weak bullish, and it closes respecting this level. The next candle, however, starts off by pushing up like this, right? Grabbing liquidity, liquidating these highs right here, but ends up flipping bearish. So it's a fake out plus liquidity grab because it pushes up first and then starts by flipping bearish. So it would look something like, something like this, right? Very, very simple. That's the fourth entry. That's an impulse entry. So you take impulsive entries whenever price breaks these previous highs right here. In this case, these previous lows, right? So a fake out and a candle that closes weak bullish but respects this level, then the fake out, and then the impulsive entries to go down. That's literally everything for this video. If you want access to the 16-page free PDF file, just join my Discord. It's in there for free. You don't have to do anything. It's a free download, right? That's it for this video. I will see you guys in the next one.